Hi, my name is Bilal, and I want to preface this by saying I am not a financial advisor, nor am I a lender. I'm a realtor, and today I'm going to be breaking down the FHA and conventional loan. If you find any value in this, I'd like to ask for your support kindly by liking and following. First off, when buying a property, you need to know the loan limit in your county. I myself am in Merced County, California, and the loan limit for a one-unit property financed with an FHA loan would be $498,257. As for financing a one-unit property with a conventional loan, it'll be about $766,000. Let's talk a little bit about what an FHA loan actually is. To put it really simply, an FHA loan is a loan that's insured by the local government. And what that basically means is that the government protects its lenders by things like a potential default. And because of this protection, you'll have an additional pesky little monthly cost called PMI, or otherwise known as private mortgage insurance. Don't worry though, because there are ways out of that, and I'll explain how to do that later. So FHA has a minimal down payment of 3.5%, only if you have a credit score of at least 580 and above. Now, if you were below that, you would have to come up with a 10% down payment, and this is not including closing costs. Now, if you'd like to put more down, you certainly can. For some people though, if you're doing a higher down payment, you might want to be doing conventional financing because it can be a better loan, especially if you have good credit. Also, one more thing about the FHA loan is that it requires you to actually live on your property. And I know you might be wondering to yourself, well, of course I'm gonna live on my property. Well, that's not exactly what I mean. Yes, you're gonna be on your property, but what I really mean is that FHA loans require you to buy a house that will be your primary residence. So you wouldn't be able to invest or get a flip property if you were to get an FHA loan. Now let's look a little bit into conventional loans. Unlike FHA loans, conventional loans are actually not backed by the government and are rather backed by banks, credit unions, etc. And contrary to popular belief, you don't actually need to pay 20% down. If you don't pay 20% down, however, the PMI comes back into the picture, because if you don't pay 20% down, you will have to pay PMI. And once again, I will tell you how to get rid of that a little later on. Now, in a conventional loan, you have the option to actually pay 3% down payment, which is even less than the FHA's lowest down payment offer. That comes with a condition, however. That condition being you would need to be a first-time home buyer, and what that really means is you cannot have owned property in the last 3 years. And in case you're wondering, that product is offered by Fannie Mae and Freddie Mac. Now, you don't have to worry if you're not a first-time home buyer. The next minimum down payment would actually be 5%, which is not too bad. It's much less than the rumored 20%. And with conventional loans, you're actually able to buy a variety of property types. This includes private homes, investment properties, and vacation houses. Now let's talk a little bit about PMI. This additional cost does not go towards your principal. As far as conventional loans go, if you have a high credit score and your debt to income ratio is within the range of where it needs to be, your PMI would be decently affordable. Now with a conventional loan, if you reach 22% in equity, this PMI payment actually falls off automatically. Another way for you to get that removed is if the equity in your home goes up by 20%, then you can request for it to be removed. But that has to come out of your pocket. And what I mean is you would need to get that property appraised to make sure that it really did increase by 20%. But it would be well worth it if you could get rid of that additional cost. So let's talk about how to get rid of PMI in an FHA loan. So in an FHA loan, it's actually a little bit more restrictive. While yes, that 20% equity is still a prerequisite, it's a little bit different in the conventional loan and the FHA loan. To get rid of PMI in the FHA loan, you would need to get that 20% equity and then actually refinance into a conventional loan. Personally, this is the only way that I know of to get rid of PMI on an FHA loan. Just a reminder that I am not a financial advisor and I am not a lender. And of course, always remember that loans vary. So if you want to find out which loan is best for you and which one will save you the most amount of money, contact a lender. However, if you have any real estate related questions, you better call Bilal. That's me.